David, great to see you again. Good morning.
Nice to be here.
To what degree is your interest in mega cap tech driven by the sort of this valuation reset of the last few weeks?
It's basically the fact that these are really good businesses with good growth prospects. The stocks are off 15%, and now they're at valuation levels that make for a very attractive entry point. Facebook and Alphabet are selling under 20 times earnings. Microsoft had a robust quarter yesterday, robust outlook, and it's at about 27, 28 times next year's earnings. So you're able to get some really good businesses at the most attractive valuations that they've been at some time. We went into this year pretty cautious on technology, but these names have come down to a point that all of a sudden they're attractive. Outside of mega cap, there are also a lot of companies that have been knocked down to 15 times earnings. TE Connectivity announced earnings today. Very good outlook. The stock is off sharply today. We'd be buying on that weakness. It is a second derivative electronic vehicle play because they make chips for all of these cars. You're getting it at a great price. So there are opportunities. We are worried about the really high PE stocks still. The 50, 100 times earnings are the ones that we'd avoid.
Right. I wonder, do you think it's a little silly that the market is so finely tuned to a couple of percentage points on an Azure forecast? Or do you think that's to be expected in this period of churn regarding the Fed?
It's a low conviction market, and there's tremendous momentum, either good or bad. So yes, it is silly, but that's clearly driving stock prices. So unless you have a great conviction before a company reports earnings, we'd be a little bit wary about stepping in. But into any weakness, if you like a business and it's at a good valuation, you definitely can buy. The thing we'd point out is if you're at a lower valuation, you tend to withstand slight misses or beats much better than a company that's at 100 times earnings that lowers their expectations by a few percent. Those are the ones that are going to get creamed.
David, give us some more insight into your gauge here, because I mean, you're saying 27.5 times earnings is an attractive entry point for Microsoft. I remember a time where that wouldn't have sounded so attractive, even for a stock that's got some decent growth.
Well, we would agree with that. So everything is relative, but within technology, we think technology is going to still be a growing area, and you want to look at it, in terms of the playing field. So there are lots of good businesses at 40 and 50 times earnings. We think those are suspect. 27 times earnings for Microsoft, we think over time will do well. But for sure, we bought Microsoft probably 25 years and years ago. We loved it down there. We still like it here. I'll point out an interesting stat. The Russell 1000 growth just had its third best decade on rolling 4 quarters since 1979. So that's out of 133 observations. You've had the third best. Typically, after great decades, growth and technology does not do nearly as well. Subpar returns, sometimes even negative. So you're right. We're worried about overall growth over the next few years because we do think it's pricey, but there are opportunities within it.
Right. And David, isn't this kind of exactly what the market is doing, though? We are seeing a re-rating in a lot of these high growth tech names. Kathy Wood said that, innovation is on sale. How do you know where the bottom is and when valuations start to look attractive?
Well, in terms of the high flyers, you're not going to know until you look back 3 months later. In terms of companies that are good businesses, but you can get them at 20 times earnings, then they have good prospects. We think that's worth the leap of faith. That's why we think like a Google or a Facebook, you can step in here. 12 months from now, you're going to look smart. 2 months from now, 2 weeks from now, who knows what's going to happen. But the key is we don't like to pay 100 times earnings. We don't like to pay 20 times sales for something that you're buying on the come of what's going to happen a year or two. We like good earnings now that are going to be growing and not pay too much. We think that's the best way to navigate the craziness that's going on in the technology sector.